Some currencies do not just reflect their country's economy. They move with the ground beneath it, the oil, the metals, the grain. These are called commodity currencies. And if you trade the Australian dollar, the Canadian dollar, or the New Zealand dollar, you are already dealing with them, whether you realize it or not. The idea is straightforward. When a country earns most of its export income from raw materials, the value of its currency tends to move in step with the price of those materials. Foreign buyers need the local currency to pay for the goods. Higher demand for the goods means higher demand for the currency. When prices fall, that flow of foreign money slows, and the currency can weaken with it. Each of the three main commodity currencies has a distinct relationship. The Australian dollar tracks metals closely, iron ore and gold in particular. Australia is one of the world's largest exporters of both. The Canadian dollar has a well-documented link to crude oil. Canada is a major oil producer, and when oil prices shift, the Canadian dollar tends to follow. The New Zealand dollar is tied more to agricultural exports, especially dairy, which makes up a significant share of New Zealand's export revenue. These three are sometimes called the commodity block. Traders watch them alongside commodity price charts as part of their analysis. Here is how that works in practice. If crude oil prices are rising sharply, a trader might look at USD CAD for potential setups, keeping in mind that a stronger Canadian dollar would push that pair lower, since the CAD is the quote currency. Similarly, if gold is climbing, some traders look at the AU for corroborating signals. Commodity prices can act as a confirmation tool, adding weight to a trade idea that is already supported by other analysis. But this is where traders can run into trouble. Commodity correlations are not constants. They break down. During broad market stress, investors often sell everything at once, commodities and commodity currencies alike, regardless of the underlying supply and demand picture. Interest rate decisions can also override these relationships entirely. If a central bank raises rates aggressively, the currency may strengthen even while its linked commodity is falling, because higher rates attract foreign capital on their own terms. Timing matters too. By the time a big commodity move makes the headlines, the currency may have already priced it in. Trading commodity currencies involves real risk. Leverage amplifies both gains and losses, and only trade with money you can genuinely afford to lose. The practical takeaway is this. Add commodity prices to your daily market review. Check oil when you look at CAD pairs. Check metals when you look at AOD. Use it as one layer of analysis among several, not as a signal on its own.